All right. Hi, everyone, and thanks for joining us today for this TCFD, the Task Force on Climate-Related Financial Disclosures webinar on banks specifically. So this is the first part of a two-part series where we're going to do training on TCFD specifically for the banking sector. And to open our training, I'd like to pass to our colleagues at the IFC, Carlos and Relitza, to give us our opening remarks. Over to you two.
Thank you very much, Tiffany. Hello to everyone from Madrid. I'm Carlos Serrano, Senior Operations Officer, Climate Business, IFC International Finance Corporation, the arm of the World Bank Group that supports the development of the private sector in developing markets. I do extend a warm welcome to hundreds of participants that have signed in for this first cohort of the virtual facilitated executive training TCFD, from climate risk to opportunities, training for bankers and financial sector professionals. The impact of climate change is introducing substantial structural adjustments to the global economy. These key changes are impacting the business and operations of banks, leading to both risk and opportunities. Climate, together with digitalization, have become the major disruption to the banking sector. For the fifth year in a row, the World Economic Forum assigned environmental risk, including climate action failure and extreme weather, as the top global risk in 2022. The banking sector has a fundamental role because it is not alien to the different physical and transition risk derived from climate change. The banking sector must embrace the climate agenda and understand its importance in terms of risk, but also, as I mentioned, opportunities. With today's evolving world, it is necessary that banks strengthen their sustainability and climate disclosure and reporting capacity, as climate risk is a financial risk that is impacting banks and can impact the financial stability of the entire financial system. With the effects of climate change becoming increasingly pronounced, disclosure of climate risk is critical for businesses. Failure to make a disclosure can facilitate poor investment decisions, asset losses, and the continuation of practices that lead to climate change. There is a growing demand for decision-useful climate-related financial information by investors, which has led to a need for banks to update their knowledge and climate-related risk and reporting framework used. And in this context, Relitza, what is the TCFD and how this initiative can be useful to the financial sector and specifically to banks?
Thank you, Carlos, and good morning, good afternoon, and good evening to all the participants wherever they are at that time. And thank you for joining us. My name is Relitza Germanova, and I'm a corporate governance officer at IFC and the lead of the disclosure and transparency program Beyond the Balance Sheet. And good night from me, as I'm based in DC today. So in today's training, you'll hear quite a few acronyms, and the most important one is TCFD, or the Task Force for Climate-Related Financial Disclosure, which is the framework that gives you the roadmap on how to disclose material information about your climate risks and opportunities that investors need. The TCFD framework was released in 2017, and as of today, over 3,800 companies worldwide are disclosing using it. Regulators are moving from voluntary to mandatory implementation of the TCFD recommendations. What is important to remember about it, it's structured around 4 core pillars: governance, strategy, risk management, and metrics and targets. And within these pillars are 11 recommended disclosures that in the next 2 trainings we are going to cover and explain to you how they particularly relate to financial sector. The framework allows banks to build on the existing work undertaken under different reporting frameworks so far, and it has a supplement for financial institutions. One of the factors for the framework's success is that the recommendations are interconnected and should be seen together as part of how the company operates and runs its core business. For example, it would be appropriate to see risk management disclosures and some governance disclosures together to demonstrate how risks are governed within a financial institutions. The 4 pillars under TCFD on strategy, governance, risk management, and metrics and targets are the core elements of the new sustainability and climate reporting standards by the IFRS Foundation and EU. As a result, the efforts, time, and cost you will put into reporting under TCFD will prepare you to report under the new standards. While TCFD adoption in emerging markets currently remains low, this is expected to change in the coming years as more countries implement policies to support the SDG 13 on climate, SDG 12.6 on sustainability reporting, and the Paris Climate Agreement. Carlos, you are sitting in IFC's climate business and intersect with the financial institutions group. What is the IFC role at the intersection between climate and the banking sector?
Carlos, you're on mute.
Thank you. Thank you very much, Ralitza. As you well know, climate action and climate finance are at the core and center of the World Bank and also IFC operations at business. No? For years, we have been at the living at the intersection between climate and the banking sector, no? Contributing to accelerate the bank's journey in understanding climate and also now adopting the TCFD reporting framework. As part of the World Bank Group Climate Action Plan that aligns our financial flows with the goals of the Paris Alignment, IFC has committed to align 85 of our new direct investment with the objective of the Paris Agreement starting July 2023. And this will be 100% of this investment beginning July 2025. So basically, we are helping banks and financial institutions in a variety of ways. First, as an investor, as IFC invests in companies and banks, financial institutions through equity, loans, investment, debt, securities, guarantees, etc., all kinds of financial instruments. Also as an advisor, as IFC works for creating capital markets through advising business and governments and institutions on enhancing policies and practices to encourage private investment and improve the investment climate. Last year, IFC alone invested $32.6 billion, including $4.3 billion in climate-related investments such as clean energy, sustainable cities, climate-smart agriculture, energy efficiency, green buildings, and green finance. This is what we're saying. Climate is not only risk, it's probably one of the best business opportunities for the financial sector. And we expect that IFC investment will help double the volume of climate-related financing, including blue and green finance, by $10 billion. So Ralitza, how we are accelerating the adoption of TCFD by banks?
Thank you, Carlos. I'm thrilled about today's training for several reasons. First, it is a result of a powerful coalition of standard setters and leading organizations worldwide. You will hear from the experts at the forefront of developing and implementing climate-related financial reporting, the International Finance Corporation, United Nations Sustainable Stock Exchanges Initiative, United Nations Environmental Program Finance Initiative, and Climate Disclosure Project joined forces to develop a learning program building financial institutions, sustainable and climate disclosure and reporting capacity. Within IFC alone, we share knowledge from 3 programs on climate and sustainability disclosure in emerging markets, TCFD advisory program for banks beyond the balance sheet, disclosure and transparency program, and GBAC Green Banking Academy. And the training will help strengthen banks' capacity on climate risk management, capacity and green lending business as input to public reports and disclosure. It builds on our IFC's UNSSC CDP training on TCFD, with stock exchanges delivered so far in 40 markets to over 11,000 companies. And we are thrilled to collaborate with UNSSC, UNFFI, and CDP in this fantastic course. And we wish you fruitful learning and exchange of ideas over the 2 TCFD training sessions, and look forward to continue working with you. Carlos, back to you.
Thank you very much, Ralitza. And I think I am at this point, I'm giving the floor to Tiffany.
Great. Thanks both of you for that great introduction and for really starting to set the scene of TCFD as not only a risk monitor, but really an opportunity. So I hope we can start off the session with that in mind. I'd like to just briefly introduce everybody to our facilitators today. The objective of this session today was really to bring into one room as much knowledge as we could to help all of you advance on this progress or on this journey. So today with you is myself from the UNSSC. I'm the head of the SSC Academy, and Evan from CDP, who's the policy manager. Together, the two of us do TCFD training with Ralitza, who you've just heard from, who's the lead for IFC's Disclosure and Transparency Program, together with stock exchanges. And we've also pulled a wealth of knowledge today from the UNFFI, and particularly today we have with us Maheen, who's the program specialist from the TCFD for Banks program at UNFFI, and they themselves do a lot of training on this. So please take advantage of all the knowledge here, and we'll help you through all of the questions you might have. So make use of that Q&A box if there's anything that's unclear, or if there's anything you're struggling with in particular. We'll do our best to move you forward on this journey to capitalize on those opportunities. Just to get started today, a few housekeeping. A few of you have been asking about the recording. This recording will be put on the UNSSE's YouTube channel. You'll get details about that in your chat. And also, I've mentioned the Q&As, but you also have the slides. So if you did not download the handout that you received when you registered, you should have got an email this morning with that handout. You can also get it from our chat box. So keep an eye on that chat box and you can follow along with these slides. There's actually additional information on that handout to keep you up to date on what we're talking about. And at the end of these two-part sessions, so we have today, we're talking about strategy and we're talking about governance, and then tomorrow we're going to be talking about risk management and metrics and targets. The holistic program is certified by CPD. However, you do have to join both sessions in order to get your CPD certificate. So at the end of the second session, we will be sharing with you how to get your CPD certificate. So today's agenda, we're first going to dive into an overview of what is the TCFD and how can it be a tool to connect climate and finance. And then we'll go into the climate reporting landscape to see, kind of setting the scene and see where we're coming from and where we're moving towards. Then after the first hour of the session, we'll take a short break, and then we'll dive into the 4 core pillars of the TCFD. We're starting with governance, and then we're going to look into strategy, looking at climate resilient strategies. And we will do a little exercise together to try to get as much knowledge as possible there. Our key learning objectives today are, we have 4. The first is to really help you all understand what are the key elements of climate-related financial disclosures that are recommended by that task force, the Task Force on Climate-Related Financial Disclosures. And why is this relevant to the banking sector? I think we just got a great insight from our opening comments, but we'll dig deeper into that. We also hope to help you to identify how climate can be integrated into governance and what the role of appropriate climate governance plays in an organization's resilience. The third objective is to understand how banks can strategically respond to climate-related risks and opportunities. And the fourth is to understand how to use a scenario analysis as a tool for climate resilience. So with that, I'd just like to know a little bit about all of you. So we're going to launch a poll here. And if you could take just a moment to fill this poll out. The objective here is just to understand where your levels of knowledge are so that we can make sure we're tailoring this presentation to your needs. So would you consider yourself a climate disclosure expert? Are you confident, but you need to better understand some of the elements? Do you have some knowledge, but you need additional support, and that's why you're here today? Or do you have little to prior knowledge, and this is really learning from scratch for you? Any of these answers are perfectly okay. We're just here to tailor our training to your needs. So we're happy to hear from each of you. I'm going to leave that poll open just another 10 seconds just to get a gauge, and then we'll move on. Okay, well, it's great to see that we have 4 experts on the call. So congratulations to those 4 experts. If you have something you want to contribute to this training, please don't hesitate. We love to hear experience from those already working on this. But the majority of you have some knowledge but need additional support. So that's wonderful. We can definitely move you guys forward. And those that have little to prior knowledge, that's not a problem at all either. But if anything is unclear, maybe I forget to spell out an acronym, or maybe a term is new to you, please don't hesitate to let us know, and we'll clarify that as we're going through. Great. So now moving on to the overview of TCFD. So just to get started, we've already heard this from Carlos, but increasingly we're seeing evidence of climate-related risks feeding into our global and systemic understanding of risk more broadly. While we're going to spend a lot of time today talking about specifically climate-related risks, it's important to recognize that it's also interconnected with all other risks that we're managing. To highlight the prioritization of climate in holistic risk management at the global level, for the 5th year in the row now, the World Economic Forum is assigning environmental risks, including climate action failure and extreme weather, as the top global risks in their annual report. Climate change and its impacts are increasingly the top issues that businesses must address, and they pose a significant risk to the stability of this financial system as a whole, which is why it's so essential that banks are getting on top of these risks and opportunities. Our current financial system does not appropriately consider the risks pertaining to climate change because the time horizons we use do not align with the time horizons for climate-related risks and opportunities. And Mark Carney's Breaking the Tragedy of the Horizon speech in 2015 was really a landmark speech. He highlighted that despite the system's threats from climate change, the time horizons for both policymakers and financial markets are too short to make the necessary actions. This observation really then paved the way for the establishment of the TCFD to help address the issue. Although it is important to note that the TCFD was developed from a financial perspective, not from an environmental one, as we're moving forward with this. So in order to understand this from a financial perspective, we have to be able to make that connection between climate and finance. And so how do we do that? Now, the TCFD provides a lot of guidance on how to understand what is the financial impact on your organization from climate-related risks and opportunities. Now, if we just start here with the risks, TCFD provides kind of a categorization of risks that a number of organizations are now using themselves. So we have, for example, policy risk at the top there. Some examples include implementing carbon pricing mechanisms to reduce our greenhouse gas emissions, or shifting energy use toward low emission sources, adopting energy efficiency solutions, encouraging greater water efficiency measures, or promoting more sustainable land use practices. And then another important risk is litigation or legal risk, which is grouped there together with policy risk. And in recent years, we have seen an increase in climate-related litigation claims by property owners, municipalities, states, insurers, shareholders, and public interest organizations as well. Then we also have technology risks. And an example of a technology risk is the development and use of emerging technologies such as renewable energy, battery storage, energy efficiency, carbon capture and storage, and this will affect the competitiveness of certain organizations. It'll affect their production, their distribution costs, and ultimately the demand for their products and services from end users. We also have market risk, which includes the shift in supply and demand for certain commodities, products, and services. And we have reputational risk, which is tied to customers or community perception of an organization and their contribution to or maybe even detraction from the transition to a lower carbon economy. And then we also have physical risks. So all of those transition risks I mentioned have to do with when we're transitioning to a lower carbon economy. And we can't necessarily guess exactly when these risks are going to come through, which is why we need to start evaluating them a little bit more broadly. We also have acute and chronic physical risks. So the physical risks are ones we're usually a little bit more confident with. We usually understand them a little bit better. However, we're not looking at them in the right time horizons always. So acute risks are those physical risks that are event driven. They include increased severity of extreme weather events. These might be cyclones, hurricanes, or floods. We also have chronic physical risks, however, which are the physical risks that are more longer term. There's shifts in climate patterns, so sustained high temperatures, for example, that may cause things like sea level rises or chronic heat waves over time. So then once we understand these risks, we can move to the next step of understanding what is the financial impact. And TCFD highlights that we can have a financial impact either on our financial performance or on our financial position. So if we're looking at the financial performance, how do these shifts, for example, in technology, impact the cost of producing our goods? Or if we're taking it up to the financial level, the portfolio that we're investing in, how does it impact the cost or even the revenues of those companies that we're providing loans for? So in the financial performance, we're looking at how does this hit the balance sheet of the companies experiencing these risks and opportunities. Then on the financial position, this is looking at more that portfolio value, the liability and equity of our assets, the carrying amount of assets, etc. So the objective of the TCFD and what it really helps companies get through is that connection of understanding what are the risks that come with climate change, but then connecting them over that sheet to the other side of how does that impact us financially? And that's really the key to disclosure as we move forward. So as Carlos mentioned, the opportunities are huge here as well. And I just like to highlight one report from CDP that highlights the opportunities can have an even greater financial impact than the risks. So in 2019, this report analyzing 500 of the world's biggest companies by market capitalization found that 215 companies representing nearly 17 trillion in market capitalization provided an estimation of the potential financial impacts for a proportion or for their reported risks. And CDP found that just under $1 trillion were at risk. However, about $2.1 trillion were related to opportunities. So the difference here is really substantial. So what are those opportunities we're talking about here? So we have a number of opportunities. We have, resource efficiency, which is often related to cost savings from reduced operating costs or by improved efficiency. We have energy source opportunities, and this could include looking at low emission alternatives such as wind, solar, wave, tidal, hydro, geothermal, nuclear, biofuels. We can go on and on. The latest data from the International Energy Agency indicates that if we want to meet net zero targets, we cannot invest in any new oil and gas projects. However, the positive side of that is that for over the last 5 years, new investments in renewable energy capacity has exceeded investment in fossil fuel generation. So the opportunities are not only there, but they're being invested in. Some other opportunities we see here are markets, so proactively seeking opportunities in markets or types of assets that may be available to diversify activities and to better position yourself for the transition to a lower carbon economy. In particular, here opportunities exist to access new markets through collaborating with governments or development banks, small-scale local entrepreneurs, and community groups in developed and developing countries as they work to shift to a lower carbon economy. Also, the new opportunities can be captured through underwriting or financing green bonds and infrastructure, for example, in low emission energy products, energy efficiency, grid connectivity, or transport networks, etc. And finally, resilience. We're going to talk about resilience a lot today, but really the opportunity that I think everyone should really take home with them today is survival. It's resilience. TCFD helps us identify those risks and opportunities that threaten the survival of our company or the companies that we're providing loans to, that are in our value chain, etc. So by identifying these risks and these opportunities, we ensure our resilience moving forward. So with that, I'm going to ask you all another question. Just a quick little quiz here to make sure we're all following along. So based on that quick, and I'm sorry it had to be quick, we started off a little bit behind time, but the quick discussion of what are risks and opportunities, what would you say are examples of a financial impact from climate on the bank, or on a bank in particular? So here's a few options here. Have a read through them and let us know which you think might be an example of a financial impact that a bank might experience. And I'll give you a moment to fill that in. Okay, well, I'm happy to say that you're all doing fantastically. So I'll let you continue filling that in because I don't want to take away the opportunity to finish the quiz. However, just to note that so far 75% of you are correct. So the first one is revenue growth from increased sustainable financing, and revenue growth is indeed an opportunity from increased sustainable finance, which could be from accessing new markets. The second one is impact on talent acquisition due to the perception that your bank is not accurately addressing climate-related issues. And indeed, not addressing climate-related issues poses a reputational risk for transition risk, which can impact talent acquisition, which impacts your financial performance in the long run. The third one is fines and judgments from new climate-related regulation. And indeed, this also hits your balance sheet. So your financial performance is impacted and can result from regulation changes, which is a policy risk or transition risk. And the fourth one, consumer preferences, again, can lead to an opportunity through markets, and also this can also lead to resilience, as we were just talking about. So all of them were indeed financial impacts from climate. So those of you who hit all of the above were indeed correct. I guess all of you were correct, because if you picked any of them, you were right. Okay, so let's move on then to what are these benefits. Now, resilience is really the key to TCFD that I hope you take away today, but it's not only for yourselves as banks, but also for the companies you work with and provide loans to. And TCFD is more than disclosure. It's about ensuring the appropriate processes are in place to ensure that resilience of your organization is in place as well. And this is really a systemic issue. It helps to ensure resilience of the whole financial system as a whole. So what are these benefits that we're going to see? Just to name a few, within your organization itself, the internal benefits that you'll see is improved strategic resilience, the identification of potential climate-related opportunities, as Carlos was speaking to, an improved robustness of risk management processes, and improved communication between board and management on climate issues, which we found in academia can really lead to increased innovation within an organization too. So that's a huge opportunity as well. Then the external benefits vis-a-vis your stakeholders is improved engagement with investors and clients as well, ensure preparedness for emerging climate regulation, improved reputation with customers, employees, and wider stakeholders, and establishing a leadership position among industry peers. So what are the TCFD recommendations? I'm going to go through these fairly briefly because we do deep dive into each of them in the training session today and we're short on time. But if there is anything unclear, as I said, just pop that in the Q&A. So the TCFD recommendations were developed, as Relitza mentioned, to help identify the information that's needed by investors, by lenders, by insurance underwriters in order to appropriately assess the financial impacts of climate-related risks and opportunities. They were developed not to create more reporting burden, to create more reports, but rather to help understand how we get the right information in our current reporting frameworks. How do we make sure our annual reporting package has the information that investors need, that banks need, in order to make decisions on these investments and these assets? In order to do this, they provided additional guidance for certain sectors, which we will discuss momentarily. And they introduced this idea of transition risks and physical risks, which we just discussed. They also heavily rely on a tool called a scenario analysis, which more and more people are using now. It used to be really the difficult point in TCFD, but we're seeing with the status updates that companies are getting better and better at using this tool. We'll do an exercise on that as well. And it introduces various time horizons. We're used to in our financial reporting to look backwards mostly. We provide a lot of historical data in order to make assumptions of the future. Now, our assumptions of the past don't really necessarily lay true for the climate of the future. So we look at these risks and these opportunities at a short term, at a medium term, and a long term, recognizing that activities we implement today might have an impact in the long term. And if we don't start it today, we miss that opportunity in the long term. And we also make use of both qualitative and quantitative disclosures. And we'll go over that more deeply here too. So the key point with TCFD is where this information should appear. And it's the number one question we always get. How do we get this into our mainstream report? Now, the first thing to remember is that the objective is to get it in the mainstream report. So it's not to create a separate report, but rather to make this information integrated into your mainstream report. And the objective of that is that the intention is not for a climate report saying this is our climate issues and then a financial report saying this is our financial issues, but to connect climate and finance together. And for those two to be connected, they need to appear together. That also ensures that it's subject to the same governance processes and it has the same sign-off as the financial report. And it makes it, importantly, accessible to all investors. When you're looking into a company you might want to invest in, you don't want to have to be digging around all through their website and different reports to try to find this particular information. So TCFD helps us to pull it all into one easy to find place. So I was talking about how we have both qualitative and quantitative. These are the four core pillars of the TCFD: governance, strategy, risk management, metrics, and targets. The first and the third, governance and risk management, tend to be more qualitative. They're really looking at the processes behind the scenes. So governance is looking at how climate is governed. So that's looking at the oversight and accountability. And the risk management is how climate risk is identified and managed. So processes that you're using and how you sharpen your vision to this. The strategy and metrics and targets components are really more your measurements here. So in the strategy component, what we really want to understand is what are those risks and opportunities you've identified through those processes, and what is the impact? We really want to get to the numbers in the strategy component, as well as in the metrics and targets. We want to measure the same thing that we identified in the strategy. So alignment throughout this is very important. We'll go further into this as we go. But as I said, if you have questions, pop them in the Q&A and we'll type back answers to you. As I mentioned, there is supplemental guidance with the TCFD as well. So we have 8 supplemental guidance documents, and one of those is specifically for banks. And let me just show you what that means by supplemental. So the TCFD in each of these 4 core pillars gives either 2 or 3 recommended disclosures. So in total, we have 11 core recommended disclosures that companies should look at disclosing. Then in addition, The supplemental guidance, for example, with banks, gives additional disclosure and support on those particular disclosures. So as an example, in strategy A, which we'll go further into later, but in strategy A, what we're looking at is identifying what are the particular risks and opportunities that have a financial impact on our organization. Banks should additionally consider characterizing their climate-related risks in the context of traditional banking industry categories such as credit risk, market risk, liquidity risk, and operational risk. So we'll go further into that later, but what's important to note here is that banks have additional guidance on how they can provide appropriate information also to their investors. So we'd like just to take a moment to find out where you're all at. So I'm going to launch one more poll here. And what we'd like to know is if your bank does prepare its disclosure in alignment with the TCFD. And as you're doing that, I'll just check. Carlos, you said you had a question that you wanted to answer. Is that correct? Or there's a question that we wanted to address? No, it's covered. Okay. But please feel free to keep dropping those questions in the Q&A. It looks like everybody's very busy typing to get those answers to you. Okay, so it looks like the majority of you plan to start your TCFD disclosure this year. That's great to hear. We have a few that say yes, but currently we only disclose climate-related information as separate sustainability climate or climate report. Okay, so I hope that your goal though is to pull that information into your annual report, and we'll work on how you can do that. There's a few of you that say no, our leadership is not convinced. So we'll work harder on that one too and provide you with some tools that you can use to start to convince your leadership. Great, I'm going to end that poll and move on. So how are banks doing? So in the 2021 TCFD status report, which was the previous one, we just got a new status report. Banks were below the all sector average for disclosure in all governance disclosure and in all metrics and target disclosures. Banks were also below average for disclosure on financially material risks and opportunities and the impacts that they have. So that's strategy A and B. However, banks were last year above average for disclosure on risk management and for scenario analysis, which is one of the areas that the rest of the markets were struggling with a little bit. But in 2022, note that the banking sector has improved significantly. So this is really great news, and it means that not only are your peers and yourselves working towards better TCFD disclosure, but it means there's a lot more examples out there that you can draw from as well. And I'll highlight the TCFD Knowledge Hub, where it's a depository of different reports, and you can particularly search for the banking sector and look at how your peers are reporting on this information so that you can learn from them as well. Let's look at a few more reports on how the banking sector is doing to provide another progress report for banks. This report by BCG illustrates that we're seeing the leadership on this space in Europe. And the most improvement here is needed in Asia. More companies here we can see start to disclose climate-related information, and then holistically the market and other companies can build a collective understanding of the risks and opportunities facing each sector. And it's important to note it also by region because we can learn from companies working in our same regions also by their risk opportunities and their risk identification. So it's important to make use of what your peers are already doing as well. In that same report, there's a figure here that identifies that metrics and targets for greenhouse gas emissions that are related to risks continue to be the most mature area of reporting, with 83% of banks reporting on this particular area. Those are highlighted in green. On the other side of the spectrum, the description of the resilience of the organization's strategy or taking into consideration different climate-related scenarios is the least mature across the industry, with less than half of banks in the advanced or intermediate stages. And a manager's role in assessing and managing climate-related risks and opportunities has had the biggest increase in maturity since last year. Now, I recommend taking a look at these documents that show you how companies are progressing, because it also gives you a little guideline to understand how you can progress through this process. It's not something that happens overnight. The TCFD often says that to progress to full alignment takes 3 to 5 years. So even when we're showing examples that might look like they've been working on this for many years, there's always improvements that can be made. Here's one more report on how banks are doing. This is by Bain & Company, and they examined the top 15 banks by assets in 3 regions, in Europe, in Asia, Pacific, and in North America. And 65% of them had pledged to reach net zero, which we'll talk about a bit more next time, for financed emissions by 2050. All of these top 15 banks in Europe have committed to decreasing carbon emissions, which they note as being spurred on by the EU and UK regulations. And of these 45 banks here, almost half have disclosed their current financed emissions, though only partially. So there's a focus on carbon intense industries such as coal, oil and gas, and electric power. They give a few examples as well. They say that ING, for instance, is measuring emissions intensity for 7 industries and absolute emissions on 90% of its portfolio. And ABN AMRO has disclosed absolute emissions on 65% of its portfolio. So again, these can be useful examples that other banks can use as they're progressing through this process. I think my favorite graph in that report here is the why. So early studies here have shown that financial institutions that act early may reap significant advantages in the future. But as you can see in this study here, before 2025, there's little differentiation among strategies between leaders and followers. So the leaders, got started ahead of time. They started investing in these opportunities and diversifying away from risks. However, as time goes forward, the gap certainly widens, with pioneers or those leaders growing profits by 25 to 30%. And this shows that the decisions made today can have a dramatic impact on the future. And this is why it's so critical that you start to make these decisions today. We just wanted to paint a little roadmap for you here. This is something we talk about in our TCFD training a lot, but that if you are starting from scratch, which some of you were, there's certain steps you can take to get started. I'll leave this roadmap with you to look at as you move forward because we're short on time, but I'll show you one process you can work through that we find very helpful. That's the Transition Pathway Initiative's phased approach. So what I like about this particular approach is that it starts from level 0 unaware to level 1 acknowledged, noting that unaware doesn't mean that you don't believe in climate change or that you don't think that government's going to change policies, but rather that your disclosure has not shown any awareness of this. So the first stage is often either setting a policy on climate disclosure, or simply a statement in your report noting that you understand that this is a significant risk and opportunity to the business and that your company is going to start to evaluate this. And at that point is often when you start to map that roadmap that we just showed. So you might want to use a roadmap to identify how to move forward, and you'll often always at that point do a gap analysis. What are you reporting on already? You shouldn't start from scratch. Build on what you already have. And then as you move forward and up this stairway here, you'll start to build capacity as an organization. You'll start to integrate this into the operations of your organization, and then finally integrate it into the strategy of your organization as well. So with that, I'd just like to see how you all may think about starting this journey. I'm going to launch one more poll here. So what key action will you take to progress climate disclosure in your organization? Will you establish a TCFD team internally? Will you conduct a gap analysis of existing reporting? Will you develop a roadmap for TCFD adoption, or will you establish internal climate governance? And with that, I might just highlight that if you are starting to conduct a gap analysis, a useful tool can be the UNSSE's model guidance on climate disclosure. In Annex 1, we provide a checklist that can be used to do that gap analysis. Just give you a moment here. Okay, so a pretty even spread, actually. The winners are doing that gap analysis, which is wonderful, and then developing a roadmap. Those are really great ways to start. I would highlight that the TCFD team can be such a valuable tool, especially to make sure that you have a climate champion in your organization, and ideally at the top, so a board level person or someone at the C-suite level, to make sure that it's getting the sufficient resources that it needs internally. Okay. And with that whirlwind tour of what is the TCFD, I'm going to pass on to Evan, who's going to talk to us about the climate reporting landscape. Over to you, Evan.
Perfect. Thank you, Tiffany. So having established the importance of connecting climate and finances and why this matters specifically for banks, in this next section, I'll specifically focus on the global reporting landscape and how you might try to understand and navigate this. So we've already established that climate change is a really important issue for financial organizations to consider and think through, but we're also seeing that this is accelerating into big changes in policy, regulation, and standards. So while the TCFD remains a voluntary market-led initiative, many governments and regulators are taking steps to require or encourage disclosures based on the TCFD recommendations. Over 120 regulators and governments around the world are TCFD reporters, from Belgium to Japan to New Zealand to the UK, and then even beyond being TCFD supporters, many countries such as the UK, US, Japan, New Zealand have taken steps to mandating climate disclosure or proposing disclosure and in line with the TCFD. At this point, as many as 15 jurisdictions around the world have either proposed or already mandated TCFD-aligned climate disclosure. So we see that there's a real regulatory and policy movement behind the TCFD. Some specific sort of areas of regulatory movement and specific requirements, especially for banks. We see on the climate financial disclosure side, TCFD guidance metrics and targets update from the TCFD itself. So according to this guidance, banks should look to provide metrics used to assess the impact of transition and physical climate-related risks on their lending and other financial intermediary business activities in the short, medium, and long term. And metrics provided may relate to credit exposure, equity and debt holdings, or trading positions. As I just sort of mentioned, we're seeing mandates for TCFD in many different jurisdictions, some particularly noticeable ones in the US. We see the SEC requirement for disclosure, the EU, the Corporate Sustainability Reporting Directive, which goes a bit beyond the TCFD, looking at other areas as well, but is very much aligned with a lot of the sort of core pillars and areas of disclosure of the TCFD. And then a key area as well that I'll get into in a sec is the ISSB standards, which are being finalized. We also see the central banks starting to go through stress testing exercises, such as the Bank of England, ECB, the Hong Kong Monetary Authority, Bank of Canada, and this could increasingly start influencing sort of supervisory and regulatory action in this space. But I'd just like to highlight that a lot of the work on sort of international standardization is really being led through the IFRS Foundation. In November 2021, so almost exactly a year ago, the IFRS Foundation announced the creation of its new International Sustainability Standards Boards, typically referred to as the ISSB, tasked with really developing a comprehensive global baseline of high quality sustainability disclosure standards to meet investors' information needs. The ISSB was announced at COP26 in Glasgow, and as you can see here on the slide, was welcomed by many world leaders around the world. The structure of the ISSB disclosure requirements are very much aligned with the TCFD, and the ISSB requirements will stipulate general requirements as well as requirements related to specific themes and industries. The first theme that we've seen is a climate theme coming from the ISSB, although we'll see other sustainability themes. And the ISSB, since its founding, has released an exposure draft on climate that will be finalized in the new year. And this exposure draft that has been released is consistent with the four sort of core pillars, four areas of the TCFD, being those sort of governance, strategy, risk management, and metrics and targets disclosure, and the specific 11 disclosures within each of those areas. Only areas where they differ really is some differences in sort of level of granularity or additional or different language used, but largely these are sort of very aligned. There's a strong alignment between the TCFD framework and the ISSB standards, as you can see here, sort of really centering on those core elements of the TCFD that are all really critical to understanding the way that a company operates and understanding enterprise value as a whole. Another thing that banks should be aware of sort of in this sort of evolving space that's very rapidly evolving and can be difficult to keep track of it sometimes is to be aware of the task force on nature-related financial disclosures as well, or the TNFD. The TNFD is developing a risk management and disclosure framework for organizations to report and act on evolving nature-related risks, kind of taking that step beyond climate. And the TNFD is in its beta version until January, and there are many ways to engage. Please check out the link on the slide if you would like to find more information on the TNFD. But what's important to know at this point is that the TNFD really builds on the TCFD, and it looks at nature-related risks and opportunities and recommends disclosures related to, as we see here, those governance disclosures, strategy, risk management, and metrics and targets. So really sort of aligning all these sort of critical areas to integrate into your operations and your reporting. But to understand some of the various approaches that are taken on sort of sustainability reporting and sort of policy, regulation, standards that we see, it's really worth having a look at this building blocks diagram that has 3 layers. On the first layer, we see sort of traditional financial reporting that you may be familiar with, whether it's through GAAP or the IFRS's International Accounting Standards Board. Then on that next layer, we see sustainability related financial disclosures. And this still has an investor focus like we saw in that first layer. But this layer sort of really connects those financial issues with sustainability issues. And sort of falling into that, we see TCFD specifically on climate, and then ISSB first on climate, but expanding to other sustainability issues as well. And then on that last layer, sort of moving beyond, we see sustainability reporting information, looking at information beyond what is necessarily financially material to an organization. This includes GRI and other initiatives with that broader stakeholder focus beyond investors. So the TCFD 2021 metrics and targets sort of guidance provide really good examples of disclosure from both financial and non-financial organizations. As you can see here on the slide, for financial organizations, there are examples of disclosures for the risks associated with greenhouse gas emissions from their investments, as well as transition risks due to carbon intensive sectors that may sort of be drastically impacted by our sort of transition to a low carbon economy, such as, for example, oil and gas. There are also specific recommendations for the disclosure of non-compliance with environmental laws and regulations. Here, reporting organizations should ideally report any sort of significant fines or non-monetary penalties for non-compliance with environmental laws and regulations in terms of total monetary value of the fines, total number of monetary sanctions, and cases dealt with through any other sort of dispute resolution mechanisms. But with that sort of quick overview of the sort of landscape, I'm happy to answer any questions in the Q&A as a follow-up, but I'd just like to ask everyone to answer the poll that should be popping up. The question is, the ISSB standards are only relevant for organizations using IFRS. Do we think that's true? Is that false? Maybe you're not sure. Hopefully I was clear enough. I'll just give everyone a moment to fill that out. Tiffany, I'm not seeing the sort of answers to this. Do you see sort of responses coming in?
Yeah, I do see the responses coming in.
How are we doing?
We're doing well. 67% have filled it in. Do you want me to end it and share it?
Sure, yeah, that'd be great.
Okay. There you go.
Perfect, yes. So 69% false. That is great. That is great that you identified this as sort of, we're seeing this is the standard that's this is becoming the standard that both investors and governments around the world are starting to look to see in terms of best practice for sustainability related financial disclosures. And this really makes the ISSB not relevant for all organizations, really who are connected to the financial system, whether through public debt, equity, or the services that it provides. So it is relevant for most organizations, including those beyond those using IFRS. And then there's another question here that we have with two sort of options that should be coming up, if you don't mind filling out this poll as well. The question is, how should you approach the changing regulatory environment? Should you, first option, maybe wait for the ISSB standards that I went over to be finalized before starting? Or should you start with the core elements of the TCFD, as this will make it easy to transition to alignment with the ISSB? Just give everyone a moment. Oh, wow. I think we might have made this question too easy for everyone. I think this is the highest response rate I've ever seen on a question. I think
They're doing well. Congratulations,
yeah,
everyone.
97% that I'm seeing so far have chosen option B, which is great. As I sort of went over, the ISSB is really building on those frameworks that came before, and especially the TCFD. So if you are really getting started with those TCFD disclosures, you're really preparing yourself for what may come with the ISSB. So great that all of you got that, and glad that I've been clear. And with that, I think we can take a break, right, Tiffany? I think we can take a five-minute break and come back.
Yeah, great. Somehow right on time. So well done, Evan. Great, everyone. If you want to just take a minute, just get up, get a coffee or tea, and please promptly return in 5 minutes. We'll get started in 5 minutes time. Okay, I hope everyone had a moment to stand up and maybe do a quick stretch. As we get started, I'm just going to comment on, there was a question that I think something still wasn't clear about why the ISSB is not only applicable to the IFRS. And I think it's just important to note that whatever accounting standards you are using, the ISSB is being developed to be used also with US GAAP, with any standards that you're using. So important to note that this isn't, ISSB shouldn't be categorized in your head as only with IFRS, even though it's the IFRS Foundation that's developing that. Evan, did you have anything you wanted to add to that question?
No, I think you've got it. And I think it just really is becoming, in addition to that, it really is becoming the sort of best practice on sort of sustainability related financial disclosures as seen by investors, by governments. And so I think that sort of wave of momentum and push behind it really makes it relevant for a whole host of organizations.
Great, thanks, Evan. And I'm going to pass over now to our corporate governance expert, Relitza. Can you take us through the governance component of the TCFD's recommended disclosures?
Thank you, Tiffany. Thank you very much. I just want to add one quick thing because there was a lot of questions about the ISSB, the International Sustainability Board standards, the forthcoming EU reporting standards, which are coming in the same time, and how they relate to TCFD. So for the ISSB one that are handled by the IFRS Foundation, it actually will be the national governments that will decide if they want to use the standards, and it was for the IFRS Foundation. So it will be decided at the government at a national level, and then the standards will trickle down to the countries that approve them. At the moment, there is a lot of discussion among the main standard setters in this area for harmonizing and doing more convergence, also benchmarking the different standards and how you can also move from one to the other. There is good examples from companies how they start with single materiality on particular issues which are material to them and then expand to double materiality. So this is an ongoing topic and journey for everyone. And with that, I will move to a topic which is very close to my heart. And now we can get into the first key element of the TCFD disclosure, which is governance. This concerns the organization's approach. Next slide, Lisa. This concerns the organization's approach to governing climate risks and opportunities, both at board and management level. As a corporate governance specialist, this is a little bit of divergence from the traditional corporate governance, which looked just at the board level. And as a corporate governance officers looking into the corporate governance of the IFC investee company, both from investor and advisor perspective, we often refer to corporate governance as the pillar that underpins the efficiency and integrity of the company itself. The reason why investors want to know about this is that they want to get context about how the bank governs and embeds climate-related financial risk into its board and operations. In particular, investors want to see that the proper level of attention is being given by the board and management to factor these issues into their operations. Next slide. Now, the first disclosure requirements under governance is to describe the role of the board in overseeing climate-related issues. Here you want to consider a disclosure and discussion on processes and frequencies by which the board considers climate change. For example, are there particular board committees focusing on the topics or considering it, like the Risk and Audit Committee most often, and what is the role of the Sustainability or ESG Committee? Are these recurring items on their agenda? What role do these committees play in particular, and what are the reporting lines? For the overall board, you want to disclose information on whether the board considers climate-related issues when reviewing strategy, risk management policies, expenditure. How are climate risks and opportunities factored into these decisions? How does the board monitor and oversee the progress against targets for addressing climate-related issues? And how is the board evaluated? And is climate part of the evaluation and remuneration of directors? IFCs reviews corporate governance risk as part of its due diligence based on our corporate governance methodology. We are updating our methodology to include a climate board governance matrix, providing step-by-step guidance on creating governance structures and processes needed for climate risk management and adoption. Second aspect of the disclosure under governance is the role of the management in assessing and managing climate-related issues. The TCFD refers to management quite broadly as any level of senior governance below board level. So it's important to keep that in mind. Here, you want to consider a discussion of what specific individual roles and committees and functions have oversight of climate change at management level. What are their responsibilities? How do they fit within the organizational structure? How are they kept informed of climate-related issues? How do they monitor such issues and the performance measures that they would consider? And how the management and the board exchange information? Because very often with the clients that we work with, it happens that the board and the management are not in good communication, and the board is not aware of a lot of the issues. There is no supplemental recommended disclosure for banks in the governance pillar. So here we use the regular, the general recommendations. Under that, the next slide, please. In its 2022 status report, the task force analyzes the current state of disclosure practices, as well as the progress made over the past 5 years. The new report was just released, and more than 3,800 organizations have become supporters of the TCFD recommendations, which shows a steady growth. And these supporters include over 1,500 financial institutions responsible for assets of over $217 trillion. Governance, although is one of the most regulated issues and the key backbone of the company, remains the least disclosed recommendations. The two governance recommended disclosure for board oversight and management role were the second and third least disclosed of the task force 11 recommended disclosures. Next slide, please. This is an example from Scotiabank, the third largest Canadian multinational banking and financial service companies, which provide banks' description of the board oversight and management role in evaluating climate-related risks and opportunities. They have a narrative about the board oversight, where they talk about the bank's climate change strategy that was approved by the board, and the 3 committees that are involved in and their role in the management of climate risks and opportunities: the risk committee, corporate governance committee, audit a review committee as well. They also talk about the management role and the role of the CEO and the chief risk officer, and the delegation that the chief risk officer has on the environmental issues to the particular environmental and social risk committee. Next slide, please. We are moving to another page of the same report, and here you can see the organigram, which makes it clear how the governance is structured. Although you need to know that while this is often a good way to illustrate the governance, it's important that the bank also indicates where climate fits, like the 3 committees that we mentioned on top, on corporate governance, risks, and audit, and how climate issues are addressed. While climate risks and opportunities, once identified, should be treated like any other business risk, they are unique in that they are not diversifiable and extend beyond the time horizons we are used to evaluate in financial reporting. As such, it's important that we introduce the oversight specifically prepared for these types of risks and opportunities. And on another page, the bank highlights the climate change as being considered within the risk committee of the board. A good explanation and a visualization of the governance is you see here from the Net Bank, which is a South African bank, and an IFC climate client in which we invested over 200 million to help it expand its green finance operations. Specifically here, it's worthwhile noting that there is the climate team, and it shows the delegation of responsibilities to the board committees and management function outlined in the organigram. The summary of the information chart helps to understand how climate-related matters are reported to the board, while the description provides detailed of the board on the board, how the board oversees the climate-related risks and opportunities, and then who the climate task team reports to in terms of climate risk committee, then the group EXCO committee, and then going to the group resilience committee as well. And where the information comes from the bank on these issues. Next slide, please. Another example to show is from the Standard Bank, another IFC client, an African largest bank by asset based in South Africa. Here it shows the specific roles and responsibilities that the different risk committees have. One important area here is the upscaling of the leadership and the board, and this is really an important area, making sure that the board has the skills and expertise, and also continuous training and education in these areas in order to keep on top of climate-related education and how management and board communicate around these areas. Often some other regulation like corporate governance codes requires that the board members have annual training and education. This is also extremely important to get the buy-in from the board, which is very helpful to bringing this agenda at top, and also the training of the board is a particular issue, as this topic has to be translated into a manageable and understandable language. Sustainability, and next slide, please. Sustainability and climate reporting is often no, the previous, yes, is often lacking, particularly in emerging markets, where private sector investment is critical to achieving the sustainable development goals. The International Finance Corporation has over 30 years of ESG experience in emerging markets, and we have the wealth of knowledge supporting our clients to develop and implement ESG practices and disclosure using our performance standards on sustainability, environmental and sustainability, and corporate governance methodology. And through our work as investor and advisor, as Carlos mentioned, we learn from our clients and any companies around worldwide they needed help with integrated sustainability and climate reporting. And to address this gap, IFC launched the Beyond the Balance Sheet Disclosure and Transparency Toolkit and Program to help companies in emerging markets go beyond traditional financial reporting to also report on material information regarding their corporate strategy, governance, risk management, and performance. And the toolkit pulls from dozens of different frameworks to distill best practices and offers a progressive way of how to do that. You've used it with companies in Kenya, China, Papua Guinea, Timor-Leste, with regulators and stock exchanges in partnership with UNSSC to develop sustainability disclosure guidelines and to support member exchanges. And the demand for both the toolkit and the numerous capacity learning events we are doing around the world, both to board and management, led us to begin developing an online platform slated for release in 2023. The next slide, please. We are also updating our corporate governance methodology to include climate governance parameter, as I mentioned, focused on climate-related risk management in our investment and advisory operation. What is unique about our approach is that we use a progressive recommendations to help companies move from basic to intermediate good and leadership practices. We look into 6 key parameters: commitment to ESG, looking into the leadership commitment to climate resilience and creation of appropriate culture, the functioning role, skill structures, and evaluation of the board and board committees and how it guides and incentivizes the management, control environment, focusing on the integration of ENS risks and opportunities in the internal control systems, procurement policies and corrective actions, internal audit, the environmental social management systems, and in the overall risk management system. And the disclosure and transparency, including materiality assessment and comprehensive reporting of the financial and sustainability impact of the organization, looking as the leadership practice to have the double materiality approach, and some short provisions on ensuring the interest of minority shareholders and broader stakeholders. And the matrix will be available in the end of November. The next slide, please. There is a number of resources from TCFD on governance and e-learning models as well as part of the general recommendation, the implementation guides as well, and the additional supporting materials which keep on being updated every year. Also in South Africa, the Institute of Directors issued a very nice guide for climate governance as well. Happy to answer any questions, and Tiffany, back to you.
Great, thanks so much, Relitza. We did have, oh no, we don't have any governance questions in the Q&A, so I'm going to pass then straight on to the next section and over to Maheen, who's going to take us through the strategy component of the TCFD's recommended disclosures. Over to you, Maheen. And I think Lisa's going to give you control of the screen, so you should be able to change the slides yourself.
Great. Thank you, Tiffany. So just a quick introduction from my side. I'm Maheen from UNIP-FI, and at UNIP-FI, I work on our climate risk and TCFD program, where most of my work focuses on scenario analysis, climate stress tests, and our sectoral work. So like Tiffany mentioned, I'll just be talking on the strategy pillar of the TCFD. So strategy is one of the 4 pillars of the TCFD, and strategy disclosures are important for showing a firm's understanding of its climate-related exposures as part of its operational resilience strategy, its planning and decision-making. And the strategy pillar can provide insights to the type, the magnitude, as well as the time horizon of climate-related exposures. And this then also includes potential impacts of climate risk as well as climate opportunities. It's also important to note that strategy disclosures need to address how an institution can then integrate these risks and opportunities that they have identified into their own strategy and financial planning. So just on to the next slide. So this slide really shows that there are really 3 main components when it comes to the strategy pillar. So you have the A recommendation. So this really focuses on identifying climate risk and opportunities. Then the second main component is then what is the impact of these risks and opportunities on an institution's business strategy, its financial planning as well, and the institution's business as well. And then finally, it's the resilience of the organization's strategy and the use of scenario analysis to identify that. So some key good practices for these components include disclosing details of the time horizon that is used and providing a justification for using different time horizons, just because different climate risks can manifest across different time horizons. So it's important to really provide that justification for selecting a certain time horizon over another, as well as to then link that time horizon explicitly to climate risks. Then it's also important to then cover the methodologies and processes that are used to then identify these climate risks and opportunities that are disclosed. So this includes providing descriptions of the risks and opportunities that are identified, as well as their impacts on the different lines of businesses, on costs, and really providing a description of why different financial metrics and underlying methodologies were used to really identify these risks and their impacts as well. Then it's also important for firms to then disclose how their organization then plans to manage these impacts, as well as then linking these climate impacts to their financial planning process as well. And then finally, scenario analysis is a very important aspect of the strategy disclosure. And this is something that we'll be going into a bit more details in the coming slides as well. So this slide really just shows key updates from the latest status report by the TCFD and shows the progress that the strategy disclosure has made. So this really shows the progress made in strategy A. So really shows that the companies are more likely to disclose information on their climate risk and opportunities. And in fact, they're more likely to provide this information than any of the other recommended disclosures. And we have really seen that progress is being made on this. However, when it comes to strategy C, which involves scenario analysis, it is one of the lowest recommendations that are being disclosed by companies, and really shows where the challenges institutions are facing when it really comes to implementing strategy C and really the use of scenario analysis. And in the coming slides, when we cover scenario analysis, I'll go over some of the challenges that institutions are currently facing. So now I'll just be going over some examples by banks and other institutions on their strategy disclosures as part of their TCFD reports to really highlight some best practices across the industry. So this example really shows RBC's use of scenario analysis to really identify some of their key physical and transition risks. So really what you can see on this slide is that RBC used scenario analysis to show different opportunities that are occurring when it comes to different opportunities related to climate change and how that can then be used to improve their strategic resilience, as well as then to explore vulnerabilities that they face. So you can see that they've covered physical risk as well as transition risk as both, and really use this to identify where their priorities may lie when it comes to key climate risk. So as you can see, it says that they've looked at physical risk scenarios as well as they've used transition risk scenario analysis to identify key climate risks as well, and then are going to be using that information and to identify their strategies and their priorities in light to various risks that they've identified. So for example, on real estate as well, so looking at how various physical risks can damage properties and how that can then impact their future planning. So the second example we have is from the IFC, and it shows how different sectors can have a different financial impact due to climate change, and then how that can be used then to adjust their investment strategy, taking into account how different sectors are impacted by climate change. So really you can see the various sectors being illustrated here on the visual on the slide, and how year by year it really plots the impacts of how the investment strategy will change due to the impact of climate change. So really looking at renewables, green buildings, various different sectors as a whole. Then the third example that we have is from HSBC, and it really covers various different climate risks that they have provided and their financial impact on their customers. So they've outlined different transition risks, looking at policy and legal, technology and demand, reputational, as well as acute and chronic risks. And they've really outlined how these different risks will then have a financial impact on their customers, and really being able to identify which risks should be prioritized. So for example, if you're looking at transition risk for policy and legal, they've looked at various impacts that regulation might have on customers as well, and increasing climate-related litigation, which can then also have an impact. Similarly, they've looked at, when it comes to their physical risks, increase in frequency and severity of weather events, but also changes in precipitation patterns, for example. And by doing so, they've looked at how these risks could then impact their customers as well. And in the report itself, HSBC has also provided a more in-depth overview of these key risks and how they could have an financial impact on businesses. So there are more detailed descriptions of these risks within the report as well. And then the report then also covers how the firm then plans to really address these climate risks that they have then identified. So the next example we have is by the European Investment Bank, and it shows analysis of their portfolio's credit exposure to both physical and transition risk. And you can see from the visual that they perform scenario analysis. And if you take a look into reports themselves, there's also a scoring exercise, a rating exercise that the institution undertook. And you can see when it comes to physical risk that there's majority of their exposure is a low risk exposure. But when you compare that to transition risk, the institution, it has a greater exposure to transition risk as well. So really some key aspects of this example is the assessment of both physical and transition risk and the use of scenario analysis, which then in the report, they go into more details on the methodology and the exercise that they took to then be able to measure the exposure that is visualized on the slide. So they provide description and a justification of the methodology they used, the process, and how they came to the results that we're seeing here. And also one thing that I would like to also identify, and it's something that we saw in the other examples as well, is then they have looked at both physical risk and transition risk. And it's really important when you're disclosing the strategy pillar for the TCFD is to consider whether you want to address your physical and transition risk separately or jointly, and if you want to consider the interaction between physical risk and transition risk as well. So the next slides. So the next slides are really focused on scenario analysis, and with that, we'll also have an interactive exercise. So the next few slides, I would just like to provide an overview of scenario analysis first. So really, climate scenarios are becoming a very important part of a financial professional's toolkit. So as you can see, based on the slide, there are various different use cases for scenario analysis that is really occurring across the financial sectors. So the use for TCFD and climate disclosure. So like I mentioned, climate scenarios are an important part for the strategy pillar, but also risk management, as well as for climate stress testing. So the use of severe scenarios for climate stress tests as well as for underwriting. So you can see firms considering using climate scenarios to integrate climate into their underwriting processes, but also then for target setting with a growing number of institutions setting net zero targets, and then also for internal processes as well. So setting and making internal disclosures as well with the external disclosures, and as well as then finally meeting regulatory requirements. So as you can see, these use cases of climate scenarios really range across all levels of different financial actors and can be used for various different use cases. And the climate scenarios are specifically recommended by the TCFD to really assess the potential implications of climate risk and opportunities on a firm's business and strategy, as well as to really understand what are the financial implications of these climate risks. However, it's very important to understand that climate scenario analysis can be used with very different methodologies as well to then identify the implications of climate risks as well as different climate opportunities. And it's very important that firms really then start understanding what these climate scenarios are, what are these pathways to then be able to use them. So this slide really just provides an overview of what these climate scenarios are and how really they produced. So scenarios are produced from these climate models known as integrated assessment models. So they're IMs, and these are the scenarios that are then used by financial firms to assess climate risk. So IMs were initially not designed to be used by the financial sector. They were initially developed for policymakers to be then able to describe what the relationship is between economic activities, greenhouse gas emissions, and climate change. And the pathways produced by IMs then project changes in energy production, demand. They look at technological changes, changes in consumption patterns, and climate policy implementation. And IMs typically provide a great amount of details on energy systems, while they also make some simplified assumptions related to climate systems and land use. And what they really show is the combination and timing of different emission mitigation approaches to reach a specific warming target. And so that really just makes them valuable when you're trying to analyze the trade-offs between different climate mitigation pathways. And I'd just like to highlight, so these integrated assessment models have been developed by various modelers and scientists. So these have been developed. So it's very important that firms are not expected to be the scientists in this case, and there are scientists and modelers who specifically work on these integrated assessment models for creating these climate scenarios. So now briefly, just before we get into our activity for today, I would just like to talk about the NGFS scenarios. So the NGFS scenarios were produced by the Network for Greening the Financial System. And this is a group of central banks who released these reference scenarios to be used by the financial sector. So currently they've released their latest scenario, so phase 3 this month. But on this slide, we'll just be talking about what some of those key categories, the key narratives of these NGFS scenarios are, which are really based on the level of transition risk and the level of physical risk. So often scenarios can then be put into these 4 groups that you can see on the slide. So you have your orderly scenarios, your disorderly scenarios, hothouse rule, and your too little too late. So in orderly scenarios, it's assumed that climate policies are introduced at the beginning, they're introduced early, and then are gradually strengthened. So both physical risk and transition risk are low. In a disorderly scenario, it is assumed that policies are delayed and they are different across various countries, across regions. So it is high in transition risk due to a delay in implementing these policies. In a hothouse world scenario, it is assumed that current policies are the ones that are implemented, but there are no additional action. So global effort is really insufficient in limiting global warming. So what you see are high physical risks in the hothouse world. In a too little too late scenario, what we see is a very late transition, which it then fails to limit physical risk, and due to a delayed transition, it also sees higher transition risks. So it's also important to note NGFS scenarios are only one group of scenarios. There are various different scenarios that institutions are using. So the NGFS reference scenarios are one of the very common types of scenarios that are used. One of the main reasons is that you can see various different supervisory authorities conducting climate stress testing and their scenario analysis using NGFS scenarios as a reference, and then adapt them to meet their own needs and their own requirements. So the NGFS scenarios are one of the scenarios which are commonly used. The other types of scenarios that are used are such as those by the IEA, so the International Energy Agency, as well as the one-year climate model, are just certain types of other scenarios by different modelers. And how institutions can decide which scenario to use really depends on the needs of the institution themselves. So first thing is considering the climate target or the warming target that they want to look at. Second is then to be able to understand the sector and the regional granularity for the different scenarios, and see which scenario meets their requirements the best as well, and then to really understand the different assumptions of the different scenarios developed by different modelers. For example, when it comes to carbon dioxide renewable, really understanding the sectoral dynamics and then being able to understand which better suits their needs. So just very quickly on this slide, resources have been highlighted to use for the strategy disclosures that can help you. For your strategy pillar when it comes to disclosing climate risk. So we have the recommendations by TCFD, as well as the TCFD has released additional guidance in terms of implementation and guidance on scenario analysis as well. So these are some great resources I would recommend everyone to take a look at. Great, so we do have a poll question, and And that is, does your bank conduct scenario analysis? So yes for transition risk, yes for physical risk, yes for both, or no, but we plan to, or no, no plans at all. So I'll just give everyone a few seconds to submit their responses.
Maybe Maheen, while everybody is filling in their responses, maybe I can ask Lisa and Vanina to remind everyone the link to the handout, because we're going to be using that handout for the next exercise that Maheen's going to lead for us. So you might want to get your handout ready and look particularly, I think it's at pages 60 to 63, I think, where we outline those three scenarios there that Maheen's been introducing, and you'll use those to answer the questions. So just if you look in your chat box after you fill in the poll, you'll see the handout that you can use for that exercise.
Great. So we do have responses in. So it looks like majority of participants are not conducting scenario analysis right now, but plan to, which is good to see. While we do have about 24% who is conducting scenario analysis for both transition and physical risk. So great. I think we can go on. So just in the interest of time, we will.
Next.
Yeah. Yeah. Great. So what we'll be doing now is we'll be conducting a scenario analysis exercise. And like Tiffany just mentioned, is that in the handout that you have received, you can go to slides 61 to 63 to really answer these next questions. And these questions are focused on the NGFS scenarios. And it really asks you to do is to look at the handout and see which narratives do you think are the most possible in the set of scenarios by the NGFS, to really think what are the biggest challenges that a 1.5 degree pathway could present. And the third question then looks at how do changes in carbon price and impact emissions, energy mix, transition, pace of the transition, and other economic activities. And then what scenarios are not in the NGFS, but you would like to see. So we'll just give everyone about 5 minutes to think about these questions and then to go on to Menti to provide your answers. Great. So I do see the results are coming in. So perhaps we can start going over through the responses. So the first question was, which narratives you find the most plausible in the NGFS scenario set? So we have the hothouse world. So then we have a couple of hothouse worlds, orderly, disorderly, so quite a range. And then we have some responses on the NGFS themselves. So disorderly as well. We do have different responses coming in, NBCs. So I think quite a range of responses in here, which one might be the most plausible narrative. Then the next question is, what do you think are the biggest challenges that a 1.5-degree pathway presents? And it would be great to get your responses on what you might think might be some of the challenges. So I'll just give everyone a few more seconds to just submit their responses. So we do have responses coming in. So lack of policy credibility. So I think that's an important one, just seeing if policy is strong enough to really drive that transition as well. Then growing physical risks as well. So we have physical risk, food shortages. I think public awareness is a good response. So I think the latest IPCC report, AR6, Assessment Report 6, also focused on lowering demand and the use of change in demand behaviors. So I think public awareness is a good one. Then changes in regulatory, significant regulatory changes are good. Transparency and accountability across sectors is really important. So I think one of the key responses in here that we're getting is policy seems to be the key challenge when it comes to 1.5-degree pathways. Greenwashing, that's a good one as well. So really are firms taking action as well to help limit global warming. So I think that's a good suggestion as well. And then how do changes in carbon prices impact emissions, energy mix, transition risk, pace of the transition, and other economic activities? So really just to, it'd be great to see everyone's responses as well as they come in. So I'll just give everyone a few more seconds while they write down their answers. So really understanding when you're looking at carbon prices, how do they impact the different pathways that you're looking at? So one thing is that they are a key policy driver for change. And I think when we are often talking about policies, carbon price is the main one. Then I think cleaner production, greater carbon reduction. So carbon pricing, again, as response is one of the instruments for climate policy. So what we really should expect is then lower emissions as well, perhaps a transition towards renewable energy from fossil fuels as well. They often also then use a transition risk. They can create a transition risk for sectors which may be harder to decarbonize or may find it more difficult to transition to lower carbon alternatives as well. I think we also have responses on perhaps the push on carbon capture as well when we're implementing a carbon price. And then finally, we have our next question, which is, what scenario that's not in the NGFS scenario set would you like to see? So just a reminder, the NGFS currently has a net zero scenario. They have a divergent net zero scenario. They have a current policy scenario as well. And then they have a 2-degree orderly scenario as well as a delayed transition one. So really, what other scenarios, narratives would you like to see? So it'll just be great just to get everyone's responses and thoughts. It would also be good to know if perhaps you like the narratives, but would like something else within these scenarios to change as well. So we can see negative carbon, lower temperatures. A lot of institutions are saying none. I'm sure the NGFS would be happy to hear that. A carbon neutral, perhaps looking at value chain impacts, supply chain impacts, some of the IPCC pathways as well. And we have fossil fuel phase out, so perhaps greater details and understanding of the pathways. And then a sector-wise approach, so greater sector granularity is one thing that we see. And then some too little, too late scenarios. So the NGFS for phase 4 actually going to take into consideration about including a too little, too late scenario as it's becoming more and more so important. Great. Thank you, everyone. And I'll just pass it off to Tiffany now.
Great. Thanks so much for that. And I hope that that kind of introduced everyone to how they can start using these scenarios as they move forward and building on them, because they keep enhancing, as Maheen was explaining, we keep improving and moving forward. Lisa, if you want to just share, great, you're ahead of me. We're just going to go through the last resources, which we only have 5 minutes for, but you have this handout slide. So you have all these resources. I'm just going to let you know how you can make use of them. And then we'll be prepared for our session tomorrow, where we're going to continue on. I'm just going to wait for the slides to catch up. I don't think I can control them, Lisa. There we go. Thank you. A lot of pressure on Lisa today. Sorry. Okay, let's fill up your toolbox. First and foremost, the recommended disclosures from the TCFD. These are all hyperlinked also in your handout. The model guidance on climate disclosure and the TCFD hub are all really great starting points, not only to understand the TCFD's recommendations more fully, but to see what other companies are doing as well and learn from your peers. We also highly recommend the use of the scenario analysis in disclosure of climate-related risks and opportunities, a technical guidance from the TCFD. Also, you can take additional trainings and learnings on this particular topic from the TCFD Hub, which has particular programs specifically on scenario analysis, as well as on governance, and then the NGFS scenario portal, which can be a useful tool as well as you're getting started on this. And of course, UNEP-FI has a plethora of resources for banks. So we want to highlight their website where you can get all of that detail as well. We're just highlighting today particular guidance from banks. So these are from national central banks that have put out guidance that can be helpful for all of you as well, and give a bit of a global perspective as well. So here's 4 guidance documents that you can use from around the world, and a list of tools. So UNEP-FI has put out a guidance called Climate Risk Tool Landscape in 2022. They updated this. So we pulled a few of their tools out here, but you can get all of their tools, including a description of how they're used and what they're used for and how they work together in this document, the Climate Risk Tool Landscape. So I highly recommend making use of those tools there. They have, I went quickly, but they had both physical and transition risk tools available there for you. I hate to say, but we don't have time for a Q&A today, but we did get through a lot of your questions. We had 51 questions asked today in the Q&A, as well as a bunch in the chat. So thank you for keeping us very busy with those questions. If we didn't get to any of your questions today, please bring it back to us tomorrow, and we will work on that question with you tomorrow. As I said, if you do the 2 sessions, you can get a certificate with CPD, and we'll share information on that tomorrow. And I'm just going to push to the end there because we have 2 minutes left here, and I really want to thank our co-organizers today. So thanks so much to Ralitza and to Carlos for co-organizing this with us today, and to our co-hosts today, Maheen and Evan. Thanks for bringing all that knowledge to the table. Thanks, Ralitza, for sharing the corporate governance expertise your team has. And of course, everyone behind the scenes making this happen. Thanks, Elisa, Vanina, Ari. Thanks for bringing everyone together. We look forward to seeing you tomorrow.